All right, the session is officially recording. Hello, everyone. And again, officially very warm welcome from my side to today's so far last scheduled Futures Course Practical Application session, part number 4, right? So as far as I can tell, everyone who is in the room watched all 3 previous parts, so we can just easily move on. And what are we going to do today? So, well, we're gonna complete the radar screen, right? The ones for our charting and the ones for our order placing, and we're gonna quickly cover the difference again between adjusted and unadjusted contracts. But first of all, I would like to cover questions if there are questions so far. So Clemens is writing in the chat box, Bernd, a quick question. Maybe I missed it yesterday, but QU and QU are not working, right? Zero volume. QH, you mean QH and QU is not working, right? Correct, exactly. Seems like these E-mini contracts, so E-mini heating oil and E-mini gasoline has no volume on the front month and no volume on the back month. So these E-minis so far we cannot trade. Maybe they are we don't know when they were created. I didn't do any research, so maybe they're kind of also newly developed CME products. Maybe it takes some time for them to pick up volume. We can leave it in the list and just observe it if at some point of time any of these contracts gain some traction. So I would just update them accordingly. I would leave them so far. I would leave everything, even the yen. I would leave even the what is it? The mini Japanese yen. Maybe at some point of time, a couple of months down the road, they get some volume and then they're tradable. So I mean, it doesn't cost us now, since we have done it already, since we have updated our list, it doesn't cost us any more time, a few seconds here and there to update. So I would leave everything, even the stuff that doesn't have any volume yet, in the list, and then we will see a couple of months down the road if maybe there is something interesting. And of course, new stuff is coming up, like crude oil, micro crude oil. That was literally, I think, now released to the public from the CME group. Because all of them, right, are all these micros and minis are all fairly new products. So I would assume it just takes some time until people, institutions, however you want to call them, realize that they're available to trade. All right. So far, are we able? Any questions so far? Are we able? Is everyone able so far? If I told them, hey, let's do gold or silver, or let's do euro, how to find the unadjusted chart, how to plot the unadjusted chart, how to plot the adjusted chart, how to plot the contract specific chart, the front month, the back month, and how to place an order, because that's actually the only thing that we need overall. Besides, obviously, we don't have to know all the specifications from top of our we don't have from top of our mind. I don't know them, but we should be aware of that there are specifications in terms of every product has their own specifications, especially then also the opening times. When does a specific market open? When does a specific market close? Expiration date, first notice date. So That's the stuff that we basically should know or be aware of where to find the data, because this is so much data. We're not able to know all of this data from top of our head. It's not required, but we should be aware of that data and should know where to find it and how to get it. Is that clear so far? I mean, kind of. I know when it comes to futures, this stuff has to be reviewed and watched a couple of times. I mean, I needed that when I studied futures at some point of time. It's not like clicking after the first time watching or listening to an instructor or mentor or coach, that it's futures is not clicking immediately, but does everything make sense, or is anything like completely abstract to someone that is like, this is way over my head, I have no freaking idea what you are talking about? Perfect. That's what I wanted to hear to get this day properly started, or the evening, right? Cool. So now, where did we stop yesterday? We stopped with the energy and metal here, front month and back month, right? As well as the minis and micros. All right, so there's a question coming in. So let me go first. Let me first go through the question. So I'm a little bit confused on one thing, please. Relationship between our individual personal risk side per trade and position size value, how to bring the two together. So what is the position size value? What? All right. So crude oil. Crude oil. All right. Let's assume you're a monthly income trader and you want to go long this zone on crude oil. I just making this up. Looks like a nice zone, weekly level, right? Really nice zone. So now, what is the first step? Maybe you guys can help me. What is the first step I have to do? No, not like analysis. We're not talking analysis, right? Please, guys, we're talking about position sizing. So crude oil is very simple, right? What's the tick value on crude oil? Who can find out what's the tick value on crude oil, on the normal crude oil contract? $10. Thank you, Clemens. Clemens, how did you find out? I mean, we know what we know pretty much from top of our head what's the crude, because it's like something that we have traded, I don't know, 5 million times on futures, right? But how did you find out? Yeah, I remember, of course. But how do you find out? Would have gone to the matrix exactly and done a buy or a sell, right? Exactly. And you would have seen on the normal contract, right? $10 is the tick value, right? So now, what's the smallest increment move? It moves in cents, right? If you place an order on crude oil, you would see it moves from 52 to 53, 4, 5, 6, 60, 61, 62, and so on and so forth. So what you now do, it's very simple. You do 48.52 minus, right, 42.4, right? So let me write this down. $48.52 minus 42.4 equals 6.12 points base or dollars, right? So now, since we know how many ticks equals roughly 1 point or $1, right? How many cents? If you know it moves in cents, it's the smallest increment. So what's the dollar? How many cents to a dollar? How many cents to a dollar, ladies and gentlemen? The most easiest question. 100. Yes, exactly 100. So Renee did already the calculation. So 100. So in total, it's 612 ticks, right? 612 ticks. Clear? So $6 equals $6 equals. Yeah, we get to that. We get to that. So now we get to that. But that's the simple part. I mean, that's the difficult part that we are doing here. The other thing is the easy part. So US dollar. So now, if you want to trade this zone per contract, right? So the contract value, the risk size on this trade, if you want to buy crude oil here with one contract and you're in the trade and the price goes here with one contract and it stops you out, you lost 6,120 US dollars. So now the question is, what's your personal risk, right? If your personal risk is $200, well, guess what? You're not allowed to trade this weekly zone, right? And then you're not allowed to, then you have to go most probably to micros and see if you can trade this weekly zone. But let's assume your risk profile is 10,000 US dollars, right? So how many contracts can you trade? If your risk profile is 10,000 US dollars, how many contracts can you trade? One contract, right? So that's futures here, and that's futures. That's the problem, right? You cannot trade now 1.8 contracts. Now you can trade, if your risk profile is $10,000 and you're allowed to take $10,000 per trade, you can trade one contract. That's it. That's the value per contract. Every tick, right? It's per contract, per one contract. That's the contract value per contract. It's always per contract. It's always, everything is per contract. If your zone is tighter, that value would be different. If you want to place this zone, right? So 52.59 minus 51.4. So here, the risk size per contract, if you traded this zone and you put your stop loss literally here, so the risk per contract is 1,190 US dollars per contract. If you traded 5 contracts, you would need to multiply this by 5, and your risk would be roughly 6,000 US dollars. It's always per contract, right? And then you decide, are you allowed to trade this zone with one contract? And if you're allowed to trade more contracts, then you're allowed to trade more contracts, and then you have to multiply that. Of course, the wider the zone, the bigger the risk. This is futures. This is different than to Forex and CFDs. In CFDs and Forex and stocks, you can always specify your risk. You can always take the same risk. That's what we mentioned, I think, first session or second session, right? That's a limitation you have with, or you had with futures. Now, since you have mini and micro lots, you can, mini and micro contracts, you can fiddle around here and there and trade minis and micros and kind of also get to your fixed risk profile. But here, if we now consider the pure contract, right? That's basically the bigger the zone, the more risk you take. Absolutely. Yes, absolutely. So you cannot like say, and this is where, if you watch again, and I explained this in the library, in the lessons, position size, right? There I do the calculation based on percentage, right? In futures, it might be reasonable to say I take 5% risk based on my roughly 5% risk based on my account value, or 10% risk based on my account value, or 8% risk based on my account value, or 3%, whatever you want, whatever you want, basically, right? And not go through the fixed risk, because that's difficult with futures to accomplish that fixed kind of having a fixed risk, especially now with weekly and monthly income. So, okay, got it. So the definition of the contract value is zone divided by position size value. Then you work out how many contracts you can afford based on your risk. Exactly. Yeah, you can. I think you mean it the correct. You mean you. I think that's the correct answer, right? Zone or position size value not divided. Well, let me. I think now. I think you got it. Even though the wording that is being used, I'm not 100% sure what is, but I guess you mean the right thing. So it's always the movement on futures is always the it's always it's always the ticks basically or the point, right? You have to calculate the ticks and the points based on the size of the zone. Yeah. Because that's the difference. That differs futures to forex, CFDs, stocks. This is the limitation that you have. So you're basically, if you want to trade crude oil, this contract. So basically, to summarize, if you want to trade this zone like we have drawn it out here with this crude oil contract, the normal contract, you have to take at least $1,200 risk on this particular trade, right? And if you are allowed to take more risk, then you can trade more contracts, right? But then if you trade 2 contracts, then you double that risk. And if you trade 3 contracts, you would triple that risk. And if you trade 4 contracts, you would quadruple that risk. And the same here, right? If you take this zone, how we have drawn out, well, then this is your risk per contract always. And if you double your contract size, you say, I want to trade 2 contracts, not only 1, because I want to have 2 targets. Well, then you take $12,000 risk per trade. Not 1 cent less. That's basically the summary, right? Uber clear. Perfect. All right. So, cool. So now quickly, one thing, I open a new workspace. I want to get a chart here. I want to get the gold chart. You can, yes, I mean, look, there are so many ways how to look up the tick value. You can look at the specification at the CME website. You can go to bar chart and see the tick value and the point values. I mean, yeah, everywhere, right? So I need this chart and I want this chart. All right, this I want to do of weekly as well. And I want to go here weekly. I'm here in the weekly, perfect. No indicators needed. All right, so 2 weeklies. So let's quickly cover adjusted and unadjusted contracts, but both of them are continuous contracts. So which one is the unadjusted and which one is the adjusted contract? Please get this right. So what is the left one? I'm staying quiet. You guys are killing me. Which is the unadjusted and which is the adjusted? So on the left is the unadjusted. That's correct. On the right is the adjusted. Exactly. So now first of all, if you watch my course in the library, you know that the history of futures and why futures was basically, or the futures market was created. It was not primarily created, not at all, for us speculators to basically speculate on movement, price movement up and down, and to gain from that, right? So when it comes to plotting a chart that shows all the contracts in the past, there's no norm for that. There's no standardization for that. It's not like you want to look at Microsoft and this was simply being created, the stock market, for gaining, right, when the stock goes up, right? So simply for speculation, basically, right, kind of. But there, it's very simple. There's a standardized way how everyone looks at Microsoft. They type in MSFT and you get a chart of Microsoft, and everybody gets primarily the same chart. The same with Forex, right? If you want to see the euro US dollar, everyone is typing in EUR-USD and you get the euro US dollar, and it looks primarily the same, slight difference from broker to broker because they get a different quotes from different banks, right? So it slightly differs, but 99.5% of the time it's like kind of in line. Now, when it comes to futures, there's no standardization for continuous chart. Now, there are two ways how you can look at this. There's the adjusted way and there's the unadjusted way. The adjusted way is more like kind of something that, let me say, all other brokers that offer futures charting, there are not many out there, right, can offer you. They just give you the adjusted chart at GC, at CL, at ES, at NQ, and so forth, and so on and so forth, right? And then you have TradeStation, the only broker in the world where you can look at unadjusted, at an unadjusted continuous chart. And from a logic point of view, this makes a lot of sense. Why? Because it shows you literally the rollover gaps. If the front month trades, for instance, lower than the back month, but is basically close to roll over, then it shows you this gap from, and it basically then on the date of expiration, or when you tell the chart to roll over, then basically it shows you a gap from front month closing to back month opening, because it's unadjusted. It's like, you could say it's it's very raw, the chart, right? It shows the reality. Because in that rollover period, because what's our ultimate goal, right, is to find unfilled orders, right? Unfilled buy orders and unfilled sell orders. I don't care about Clemens's unfilled buy orders and sell orders. This doesn't benefit me, right? I want to find institutional unfilled buy and sell orders, meaning they would trade during a period of high volume, kind of, right? Even though the volume I don't have to care about, because volume is filled orders, but I know when institutions trade, because they have to fill orders, right? They don't fill orders when the volume is, they don't fill, I want to, let me rephrase, they fill orders when there is a decent volume to fill orders, and they are not necessarily filling orders on expiration date or one day before expiration, because this is where everyone is just saying, okay, screw this contract, I'm rolling over because I need liquidity to get into the market. And also institutions need liquidity to get into the market. So they avoid, obviously, also to trade or to trade very close before expiration. And what's the point to trade very close? There's no point to trade very close before expiration, because you would then have to roll over anyhow, right? So somebody who trades on expiration date, or some like who is opening a position on expiration date or one day before expiration, must be kind of a day trader, because he is basically, or uneducated, because he has to basically close, he or she has to close their position at the same day or the next day, right? So if you remember in the lessons, if we looked at the volume, you would see that the volume, the closer the expiration comes, the volume is decreasing, right? So this is not the place where we can find institutional unfilled orders. So that's why we use the unadjusted contract to basically remove the noise, so to say, where we can be sure the last 3 days where the road, like for instance on the S&P 500, right, where on the S&P 500, right, on the S&P 500, or let me say on gold, even better, on gold, where we have a first notice day, and then after the first notice day we have a 20-day settlement period where there's no volume, where there's no trading happening. So why would we, right? The logic is to showcase these 20 days on the chart doesn't really make any sense, because on these 20 days, even if there's a candle, this is pretty much very unlikely that we can find a high quality zone, meaning consequently high quality, meaning a zone where we can find unfilled institutional buy or sell orders. So we basically remove here these 20 days from the chart, which is basically the period between first notice date and expiration date, because there we don't find, because there's anyway no trading activity. Is that logic? Does this logic make sense so far? So we are perfect. So for everyone, yes, Renee, perfect, nice, nice. Because this is kind of, I think this is like one of the most complicated things to get your head around. So let me continue. But we're going to simplify it as much as possible. So now let's avoid looking at the plus GJMQZ for a second. I'll come to this later. So let's now just focus on these unadjusted values, the 20 here. So if we look at GC, right, which is the adjusted, this just takes into account literally every single day until the last trading day. So including the 20 days where there's no trading activity, where there is the settlement process happening, where you basically don't have any kind of trading activity, trading volume, no liquidity at all. Plus, when the rollover happens, and the chart at GC is used by institutional algorithms, because algorithms can have a hard time reading gaps as well. So somehow the programming of the adjusted charts work in a way that the gaps are getting erased by just adding a candle that you basically don't know that there is a gap, right? It's just like, okay, the front month is trading lower than the back month, so there would be naturally a gap up, but the adjusted contract just automatically by default is programmed that way that it can just basically closes the gap then with a green candle. You will not see that there's a gap, right? But it's important to know that there's a gap because these gaps also tend to get filled. And this can make a difference, right? When we basically want to place a trade below the gap, or we are rolling over, that we don't basically open a position before this gap is being closed whatsoever. It can have an impact on our trading, so we cannot deny that. So this is kind of an important factor. So the logic tells us that the unadjusted chart makes a lot of sense to use for us finding high quality zones, meaning areas where institutions want to buy or sell. Now, however, right, there's two sides of the medal. As I said, there is no norm for that. There's no standardization. So a lot of institutions who are not using TradeStation, for instance, right? Not the whole world, not the entire, even if this is one of the major progress to trade futures, even in the US, even for institutions, big money managers. Not everyone is trading on TradeStation, right? You might think so because their response time is very, very lousy. They're very slow in responding, but it's not the case, right? So having said that, that was a joke, by the way. Having said that, if you said, I want to use for that reason, because a lot of people, let me call it people, are looking at the adjusted chart. I want to look at the adjusted chart. This would not be wrong, right? So what are we looking then now, right? This is where the confusion comes, because there's no black and white. It's not like Microsoft MSFT, and if you don't plot MSFT, you're wrong, right? Here you can literally plot at GC equals 120xn or at GC, right? And both is in their way kind of right. So first of all, give me the answer. Let me give you the answer first. You should be always consistent with one market, right? You cannot basically say now, okay, on gold now for the monthly chart you use unadjusted, and for the weekly you use adjusted, and for direction you use then again unadjusted. This is not how it works, right? You should be consistent in what you are using. And ideally, you should also maybe use, and I'll show you one more example why I feel sometimes, and it's basically on crude oil, it's very interesting and has also their pros and cons. Sometimes we should always look, and this is when I do futures live trading, that I always double check on both charts, especially if we look way past into the history, because there we find the most differences, and I'll show it to you on crude oil. And for instance, here you see that the chart looks a little bit different, not the near history, right? I mean, and that's if we find a zone like here, You see, this is pretty much, I don't have snap mode on, but this is pretty much the same as you can see. But already looking at 2020, you see here the weekly zone has been penetrated quite a lot of times. Here, this single rally-based rally. However, here, it's still completely fresh. And down here, for instance, price went into the origin here, into this level, deep into this level, and basically would have kind of stopped you out here. Maybe not, maybe yes, right? Depending on where you have your stop loss. But here on the unadjusted chart, it basically held nicely. So obviously, by having said that, do I know which is always the right chart to use? No, right? Because again, there's no norm. What we have to be is basically just being aware that zones, particularly that lay way past in history, that have been created in in the past, can be different. And that's why we should always be aware of both charts. We can use as our standard the unadjusted chart, but if we basically gold was what I'm saying, gold at some point of time is collapsing and is coming all the way down here, right? Then we have to see, okay, hey guys, let's check also the adjusted chart and see the pricing of the zones and double check the value, the pricing of these zones, because look at this here. This zone is at 1361 and the same zone here is at 1455. Big difference, right? Almost 100 points, but it's the same. It's the same. It's the same. It's the same chart. So I would always use my take on that. I would always use for an analysis purpose the unadjusted chart, but just to be aware if zones are located way past in history, I will basically double check and cross check. Hey, what is the adjusted chart also telling me? In the adjusted chart to plot is always very easy. You just type in at whatever the two symbols are, right? Now, if we look at CL, one second. If we look at CL, this is where we can see one of the biggest differences when it comes to adjusted and unadjusted chart. So it's 103 XN, yes. At CL equals 103 XN. And I look at the monthly. Then I see one disadvantage and one advantage of the adjusted chart. If I look at the high, the very high of the adjusted chart, I know, right? We know the COT Well, the COT has nothing to do with the chart, right? Let me, good question. I think, yeah, very good question. I think Mike in one of the futures sessions had the similar question once. But yes, I'll get back to you, Renee, on this question. Very good one. Now, if you look at the high here, crude oil, right, at 224 US dollar. Crude oil has never been traded in its entire life cycle, and this is supposedly in 2008, right? Never been traded at $224, right? That's just not the correct all-time high of crude oil, right? That's just not right. Whereas if we can, and everyone in the world who looks at this chart will see this price, and this is just not right, right? But if you look at the unadjusted chart, where you literally look at the front month and at every single front month, waiting for deducting the 3 days where there is no trading volume, and then rolling it over before that, telling the chart to roll over, going to the back month becoming the new front month, you see then basically that the all-time high was 147, and that's the correct all-time high. All right. Again, you see the difference comes from prices that are way back in happened way back in history, right? Now, look at this high here. This high here. If we look to the left, here we collapsed. Here we collapsed. If we look back to the left, we see, hey, why did price collapse? Right? How come price collapsed? There is no supply zone. Right? We always see, right, especially if we see a big collapse, we must see some kind of a zone there, right? Or at least a wick over wick, like we see here, that wick over wick here. And we know that on a weekly, this is a high quality zone, and that's why price dropped, right? But here we don't literally see anything. It's just an explosive candle, and the likelihood that price just collapsing from an explosive candle is almost none, right? Now, if we go to the adjusted chart, what do we see here? Surprise, surprise. We see a super crazy quality rally-based drop on the monthly, right? And of course, we can tell, right, the likelihood that price stops in this super high quality monthly zone is very, very high, right? Whereas here we don't see it. And here on the adjusted chart now, we just, by coincidence, we see it, right? Because here you see the zone that was created in 15 is much, much lower. Right? And right now, for instance, if you look at crude oil, we are basically located in a very quality rally-based drop, right? In a very quality monthly, this is the wider version, preferred version, it touches already the wider version, where we already touched once, and when we touch this one, we got this major collapse. So guess what, right? What can we expect from this zone? A lot of unfilled orders, or only a few unfilled orders, right? Most likely in here, there are located a lot of unfilled orders, and this is kind of a clear zone. Whereas here, right, on the unadjusted chart, we are already like on that top. We are on the same area where price once also collapsed. So here we could anyway say, if we compare both charts, I would say, well, here we are in a supply zone, and here we are also in this major supply zone. So it doesn't really matter whether I'm deep inside here or just touching this one. I'm in this high probability sell area where price is very likely to retrace back a few dollars here and there, right? It's important, right? And this is where the confusion comes from. So now which chart to use? Be aware that always check both charts and see if there's a huge difference between these charts, and then be aware of, hey, am I located in the same zone, similar zone? Is there a zone? Am I on one chart I don't see a zone, and on the other one I see a zone? This is then of course a problem. But again, this only happens if if price is traveling, if price is extended very much to the upside or downside, where we have to look to the left for a long period of time to find a zone that has been created a couple of years back, and then we have usually this issue. If we are looking for a zone that is just being created a couple of months back, or just now trading a breakout order or a hammer candle or whatsoever, this is not an issue at all. But if we have to if we have to find a zone that has been created 3 years, 4 years, 5 years back, then we should always double check and see, hey, what is the adjusted chart telling me? Is it telling me the same story? Does this make sense? It's very important, actually. But we would always still just check the unadjusted chart, and then also, of course, just be mindful and be aware that the adjusted chart also has some value. Renee, Sina, all clear? Francois? Clemens, you want to add something? How you have handled this in the past? Now Renee's question. Yeah. Does the COT work equally on both? So the COT numbers, they have nothing to do with the chart, right? The COT is just collecting the number of contracts being traded regardless of how the chart looks like. The indicator looks obviously and then therefore, since the report is independent from the chart, it looks the same on the adjusted, and it looks the same on the unadjusted chart. It looks always the same because it's independent. The numbers are independent from the candles. It's collecting basically real life contracts, right? So you can use it for both charts. Question on rollover days, it's not exactly the difference between you never count public holidays, and you never count weekends. But again, please, I can only urge you guys, and because this stuff, again, how the rollovers are being calculated is clearly beginner module 2 life cycle characteristics is being explained here, right? And it tells you, okay, you will see immediately, okay, weekends, I don't count the weekends for rollover days, just trading days. Anyway, you guys have to watch this not only once, you have to watch the whole thing. Most probably now, after this practical application sessions, these 4 sessions, I think now watching all of this makes a little bit more sense than when you watched it the first time. It was maybe then a little bit abstract. Are we cool for that part? Very. I'm happy to hear. All right. And by the way, and this is something that sometimes even, you know, we could forget that, you know, when we do the analysis, that we just go through the unadjusted chart, but you can always remind Jan, myself, when Mike is doing a class, or even Tobias in the German class, hey, Tobias, can you place for the Germans, right? When Toby like, or telling me, hey, can you have a please a look on the adjusted chart and see where we are and what's the pricing, right? All right, so I think this was the last thing that I wanted to cover. Now let's get back to the to this stuff here. So what we need to do now is adding here the energy and metal group, the unadjusted chart. So we have to add here a column at label row, blank row. How many we need again? 4. And by the way, what I would recommend for you guys to do is just now the trades that you take on in a live account, because everyone I see in the room is trading heavily live, right? Fully loaded live is full risk amount. That with different kind of brokers, just that whenever you take a live trade with a different broker, just try to take this trade in a simulator on TradeStation, just to slowly get used to it, because that's, you see now that TradeStation futures, it is like different animal. It's like a whole process by itself. So whenever you take, when well, when there's hopefully another add-on on silver, right? I let you guys know, by the way. Then take that add-on just in a simulator on silver, right? By doing the proper contract sizing, position sizing, proper micro or normal contract, and so on and so forth. So that's what I would recommend, right? Just to get used to everything. So now, well, if you want to take an add-on on silver, on a normal silver contract, well, then you need to fund your TradeStation account by just quite a bit. So what I wanted to say here, energy group mini. So you remember it's E-mini crude oil, E-mini natural gas, E-mini heating oil, and E-mini gasoline. Even though heating oil, gasoline has no volume, the E-minis, we plot them anyway. It's quickly, right? And it's very simple. The E-mini crude oil is QM, natural gas is QN, E-mini heating oil is QH, and E-mini gasoline is QU. So QM is for QM is crude oil. So what is the unadjusted chart for the E-mini crude oil? $5 million question. If the symbol is QM, how can I easily derive now the unadjusted chart? QM, what's the unadjusted chart, ladies and gentlemen? QM, perfect. Yay, right? at QM equals 103xn. So now I'm surprised. I know this exists forever, but still wanna. And again, right on these. So if you do the analysis on the E-minis, you don't see the COD data, right? Because COD data is derived from the real contracts. QM. Now, what's the next one? QN. So at QN, at, oh, no, wait. At QN equals for natural gas 103xn. Then we need heating oil at QH equals 103xn, and gasoline at QU equals 103xn. And look at the daily chart here, right? And this is exactly what happens if you don't have volume. So again, back to the logic of unadjusted chart. So why would you ever want to see charts that has no volume, and you would basically normally see these dots? Doesn't make any sense, right? But minis are contracts too. No, everything is contracts. Mini contracts, micro contracts. In futures, everything is contracts. It doesn't show on the minis because it's always the data. There's no fundamental data on the mini contracts because it's always derived from the real contracts. So now we do energy in metal group micro. Because why would an institution trade micros, right? These are done for at Planck Rho. It's just a derivative. It's moving the same way, right? It's just a derivative from the real one. At Planck Rho. So we need now the energy in metal group micros. At Planck Rho. At Planck Rho. So energy and metal group micro. So now we have gold, silver, and micro crude oil. So gold is MGC. So, oh my goodness. At MGC equals 120xn plus G J M Q set. So again, quick now just a quick explanation. So why are we using on gold, for instance, plus G J M Q set, and on silver H Q N set, and for a lot of agriculturals we use that plus as well, because exactly that's the reason is that there is one contract that is historically, for whatever reason, not being traded with a high volume, that has very, very low volume, minor volume, where you would see only dots. So do you want to showcase these dots on your charts? Because it's so for gold, for instance, it's the V contract. V is for November, if I'm not mistaken. So why would we want to showcase the V contract that has no volume, that is being skipped even by institutions? They move from Q to Z because this is where the liquidity is, historically where the liquidity is, where you can fill orders, right? So why would we want to have the chart kind of I don't want to say misleading chart, but why do we want to include a contract in the chart for every single year that has literally no volume, where we can basically not find, logically speaking, that's the rational, where we cannot find institutional unfilled orders, because this one is skipped by institutions because it has no volume. So how can we say it is skipped by institutions? Are they telling you to skip it? No. But if that is basically, if you look at the V chart and look at the lower time frames and you see only dots and very low volume compared to all the other contracts, you basically, what can you derive from that? You can derive that nobody's trading it and a few retailers are trading it. So if the volume is low, it's for sure not big institutions who wants to trade gold, right, on these contracts. Clear? That's why we remove on the unadjusted charts, when you have the plus blah 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 blah, the contract month, the one contract, if there is one contract that is literally the black sheep that has no volume, no liquidity, you remove it from the equation to showcase more like of the raw realness chart. Make sense? That's why you have these on some of them, especially within the agricultural group, you have always one contract that historically has no volume. Kind of clear? Cool. Now, heat, natural gas, where am I? Silver, SEL. So silver is here. At SEL equals 120 XN plus HQN set. And now on what else do we have? Micro crude oil. Now let's see what we will see. Now this is now, I'm curious about M at CL Q21. Whatever. No, I was MCL equals 103 XN. Now, what is this one doing? You see. Now, there's no data on the chart. Now, that makes it, of course, difficult. And yes, Francois, you're right. And then you see basically, you see when it was launched. It was literally launched 4 days ago, right? It was launched 4 days ago because this was the first candle. This makes it, of course, we cannot analyze this chart, right? You see that? That's the problem with all these new products. It was the same when Bitcoin futures was launched. It was already, there was a Bitcoin chart available, but not in the futures market. So it basically, the first day it was introduced to CME Group, that was basically the first official futures candle, even though you had candles much more, I mean, on different charts, on different platforms, right? BC, the Bitcoin USD chart, you had a fully developed chart already, but in futures you had only one candle, right? It's like basically the IPO of the product. It was just right, so to say, in the exchange. So has anybody an idea to how to trade? I mean, now you cannot analyze it. So what would you do? But remember, if you want to trade crude oil, what would you do? If you want to now, let's assume price is today in that daily demand zones and you want to buy it. But of course you cannot buy, maybe you have your risk profile is a couple of $100 and you cannot trade the full contract. What would you do? Exactly, Renee, you're right. Sina, you're right. Exactly. You would analyze the real contract, absolutely. And if price is in that zone, right? If I go to the real if you now, and now the hammer shows, but if you wanted to buy in that demand zone here, for instance, right? In that rally, in that chop-based rally, you would have just triggered that buy once the real contract is in that zone, and you would then place the order on the micro. Exactly. Clear? This is how you would do it. If you cannot see the chart on the micros and on the minis, you analyze the real chart, do the zoning there, obviously, and then trigger it once price is in the zone of the underlying asset and not of the micro and mini derivative. It's a little bit of headache, but yeah, you will. This is pretty much still straightforward. Cool. So we have done now that part. So now we have 15 minutes left. So we have only a few things left. Which is basically also the I think perfect timing. Now we need to agricultural, right? We have corn, we have wheat, we have soybeans, we have live cattle, we have lean hogs. So now let me split this a little bit better, because we have also products like soybean oil. I want to put on a chart, soybean meal, oats, rough rice. These are things I want to put on the chart here as well. So let us do this together quickly. So corn, right? Let's do, and let's then have meats in a kind of different group, right? Softs and meats, right? So let's do first the agricultural. And I think if we cannot finish this, then obviously we schedule for next week one more session. Anyway, I wanted to have at least one more follow-up session in case you have some questions or so after reviewing maybe the futures topic. And I would like to go maybe more in detail when it comes to analysis of these new products, soybean oil, soybean meal, and yeah. Cool. So corn symbol remains. Corn right now, I just know from this, some things I know from the top of my head. So CU21, so U is the contract right now on corn. On wheat, it's September. You know now how to write. We can do this quick. I do this quickly because you know how to basically now find the front month, right? Soybean SQ21. We have now, I want to add here what we have not looked at, soybean oil and soybean meal, because you might think they are correlated a little bit, but these charts, especially soybean meal, looks different, and the volume is also decent. BOQ and soybean meal SMQ21. I want to add oats and rice as well, even though the volume is very low, but I think you could still, let me see, looks like, yeah, you see, I bought. You see what I did? The volume is very low, and it's nice that this happens. I was not aware of that in the simulator. I thought you cannot get slippage in the simulator. Look at this. 61 contracts so far being traded, and I just bought market once, and I'm immediately now I'm okay, but I was immediately down $75, so I think I got slippage immediately. But you see, this is moving very slow, but it's tradable, so we would need to just see if this makes sense, right? If we do some monthly income or so on oats, right? If the volume is really low, monthly income always works, but if there's a nice opportunity monthly, why not? So what happens if I just close it? No. Just wondering, did I get slippage on the closing? Filled. Filled price. No, I don't think that's why. Life would have been for sure different. All right, so now what I wanted to do now, oats, and I wanted to add rough rice. So rough rice symbol is RR. U is also U21. So now quickly the back month. C set. So after U usually set, right? Set. W set 21. SU 21. BU U21. SMU 21. OZ 21. And we have rice RRX 21. All right. Now we add more because now we need the minis. There are 3 minis available for us: corn, wheat, and soybeans. So I add this in a here at label row. Agriculture group mini. So we have corn mini is YCU21. So YC is the symbol. For wheat is the symbol YW21. YW, but yeah, YWU21, the contract month U. And for soybeans, the contract month is it's the symbol is here. GK21. Y. Okay. YKU21. Yes. YKU21. All right. Now the back month. Agriculture group mini. So back month, surprise, surprise, is set. Why? Oh, no. Oh, good. This is when you don't have an undo button. Agriculture group mini. Y say C set 21, YW set 21, and YK set 21. All right. Meats. Now, what did I do wrong here? It's Q. Oh, I made a mistake. This is, sorry. Here, this is the back month actually. YKU21 and the front month for soybean, sorry, is Q. Why? That's why I was confused. Something seemed odd to me. So now higher volume, of course. Good stuff. Now meats. Meats. Very seasonal product. They have nice seasonal highs and seasonal lows. So something we should really consider to trade with our indicators in the future. So we have 3 meats: lean hogs, live cattle, and feeder cattle. So symbol for lean hogs is LH, contract months front. Where am I? Contract month. So the contract symbol is LH. The front month is Q and 21. Lean hogs. Live cattle, LC, also Q. They're all Q. And the feeder cattle, FCQ21. Back month, LHV21, LCV21, and FCV21. And now I'll add one more, which are the softs. Softs we would actually write, unfortunately. Now, if you get the data for ICE exchange, right? I mean, how to then plot sugar, coffee should be by now hopefully self-explanatory. The only soft that it's not really a soft, but it actually CME Group lists the product in the soft category. I don't know why, but it's lumber, right? So lumber. So actually lumber expired today. You see, wait, I'll show you. LBN 21. It's funny, the name, random length lumber, random length. So you would buy random length of lumber, right? Short, long, who cares? It's random length. So you see, expiration today is the 15th. So we can already remove it and use lumber LBU21, and I assume, I've never traded lumber, that there's a set. There's no set. So then let's do the following. Look at bar chart. September. What are we doing here now? November, January. We're in January. F. So the back month is F. LBF22. Sweet. So this part is done. Now here we have already everything except soybean oil and soybean meal and the meats, right? So where do we get these from? The unadjusted. So wherever we have, now we get this on the cheat sheet. Some of these we have, right? And if you don't know, if for instance, soybean meal, right? Let's assume agriculture. I don't have soybean meal here in that cheat sheet, right? However, here you have soybean, here you have soybean meal and soybean oil as well. By the way, and if you didn't have it here, then you know, hey, this is grains. And grains is then, you see here, XN, it's always 10, the X days before. If you want to plot it yourself and you don't know where to find the unadjusted chart, then you use this one as a helping tool or that one as a helping tool. So can I just soybean meal copy that actually and paste it here? Perfect. And look at this. Nicely seasonal. You see that? Soybean meal. And if you compare it, for instance, if you would think, hey, this is the same like soybeans, pretty much very strong rally versus soybean meal. It's a little bit weaker, much weaker, right? And nice, you see, it's behaving nicely, like nice seasonal. So something that we should definitely consider for, of course, longer term position. Now, where's the PowerPoint here? Soybean oil. I make myself now my life easy. Zick. Copy paste. Copy mixed up live cattle. Cool. Okay, thank you. I'll change that. Is that actually from the? All right. Now look at this soybean oil. Also nicely seasonal, right? And if you look at the zones, see also the weeklies, right? So very nice seasonal product as well. Clear uptrend, right? So all the demand zones here, right? Like most probably at some point are nice buying opportunities. So why not keeping that on a chart and looking out for nice opportunity coming up. What's the next one that I need here? Do I have all agriculture? Do I miss any agriculture here? And by the way, you could still plot the things that you see here. Cotton, it's delay data. I don't have live data right now here on that system for eyes. And then you see you get this D here on the symbol. You could still do the exercise and plot, I mean, sugar, cotton, coffee, all these ice products, right? You could still add them here. You can do this yourself then as well. So what is missing? What is missing? What is missing? What is missing? Oats. Oats and rough rice. So oats and rough rice, I've never, right? No, so now what do we do with oats and rough rice? For now, I don't have it here in the list. So I would now consider, first of all, we use all contracts. I would classify oats and rice as grain, right? It doesn't mean anything else, right? So I would use now as an unadjusted just xn OU at OU equals 110xn, right? And then I have to say, we would then, if you really like, at some point of time, consider, or we at some point of time consider to trade oats, then I would really like to dive deeper into oats, looking, hey, is them looking at all contracts, historic volume, looking at, hey, is there maybe also one black sheep? Like in a lot of these agricultural products, there's usually one contract that has I mean, in general, oats is low volume, but if there's one contract that doesn't have volume at all, so we would not use it in our chart. So this is something we would look at once we really want to say, okay, there's a nice zone, let's trade it, and we would really break down oats to see all details and all specifications, opening times, closing times, and real volume, and every single contracts to see what makes sense here. And you guys are having a party, I can tell. I'm not sure if you guys even still listen to me. At OU equals 110xn. At O equals 110xn. Seems like also, you see, that's why really nice chart. Look at the zones. Look how this little thingy nicely worked, and then price came back into this and worked, and now rallying higher. And it's looks like also very much low and a high and the low and pretty much another high. And now soon we should drop, right? Is there a supply zone to the left, or is this all-time high? And then here now, we have more or less this level on top of level, where price right now bouncing, and this should be the high, and from here we should big move down. See, very nice. Very good looking. So this is oats. Now rough rice. At RR equals 110 XN. Rice got expensive at some point of time last year. This looks to me like a bear flag, but the chart looks horrible. But also, you know, see here on a daily, even for these products, obviously, I would not go for daily. I would really go for weekly zones. But if you look at the seasonal here, should also here a little bit sidestep and then fall as well. Kind of makes sense. If you look at the bear flag here, drop, huge bear flag, would also make sense. Just brief, right? Just brief analysis, looking if the charts kind of make sense. So now we do quickly the agricultural mini, right? There we don't go into the analysis. I mean, this is not real analysis, right? But just looking if everything makes sense. Agriculture group mini. So we have corn. Corn is at, oh my goodness, YC equals 110 XN plus HQNZ. Next one is wheat, Y. Wheat equals 110 XN plus HKNZ, yes. And then we have soybeans at YK equals soybeans, sorry, I'm lost. 110 XN plus also soybeans, yep. FHKNX. All right, now the meats and the softs, and then we are done. Literally done. Meats. I can copy paste now here. The hogs. The cattle. Now, ladies and gentlemen, I have never traded. I have never traded lumber and I've never traded feeder cattle. So, and since you see also, if I go back to the matrix, feeder cattle and lumber they don't have first notice day. Otherwise, I could derive, right, easily the XN, right? I could tell the system, I could look at the calendar, deduct the days minus the weekends, and I would do that. But right now, in that case, you have that. You have feeder cattle. Oh, perfect. Do you have also lumber? Clemens, that's why Clemens is the man. Good. I would have just said, okay, I would have said, yeah, okay, I would have just at FC in the meantime. But great, okay. Just copy paste from the chat. Do we have lumber? Oh, what a crazy dude. All right. So if you need a product that I don't have, just ask Clemens. Oats is okay. We have oats at equals 110xn, so it's fine. That's a grain. And rough rice is also grain. It's always grains are always 10. So that's why I would just use and then we would need to check, right? At some point of time, is there a contract that has no volume? But I think that's okay for now. All right, we completed that list, the unadjusted list and the front and back month radar screen, right? All are radar screens technically, but the radar screen for the unadjusted chart, the radar screen for the front month, and the radar screen for the back month. The radar screen for the unadjusted chart, you never have to change, right? That's fixed. Once you have done this, that's fixed forever, kind of, right? But the unadjusted, this kind of worksheet, workspace, that's more or less a living document, right? Because there you have to change if the front month expires, remove it, back months you move there, and then you have to find a new back month. But this then takes you the symbol column for then for the recording as well, like this. Thank you for, because that's, yeah, for the recording viewers then as well. Guys, questions, comments? I want to do a follow-up session. I'm not sure if I'm doing this next week or because after next week's, I'm 2 weeks at least on holiday, flying out. Otherwise, I would do that then just a follow-up session after the holiday, because I want to talk also just briefly about open interest, look at open interest. And yeah, then we covered everything from my side. But if then there's some questions, we can cover that in that follow-up session as well. Cool. Thank you guys for participating the whole week. It was my pleasure. I think now we covered literally everything and you can start trading futures, at least in the simulator, and you know what to do. And please review the course material again, watch it again. And now it makes definitely more sense. Watch these 4 sessions again and then start trading a little bit of futures, right? Because futures is the future. All right. How did I know lumber? Because I checked on bar chart. Bar chart. You will see it on bar chart. There all contracts are listed. Similar we did for everything else. You click on lumber and then you see the contracts that are listed. After the front month comes the back month. Yeah, but then you know this contract is not that. Then you know that basically you don't have a. Then you don't have, because it's not then. It's then behaving similar to the S&P, where you have only 4 contracts per year every quarter. Then on lumber you have, I don't know how many contracts per year, right? It's just the contracts that are given. There are no September, November, right? All right. So September, you expired today. September, you expired today. So there is no front month, so expired today. So this should be November. That's correct. So X. So this should be X. That's correct. That's correct. LBX21. And then the next one is January. That's what we have. Random length lumber. Yeah, that was a mistake. Cool. I think that's it now. Yalla. It's almost 2 hour session for the recording viewers. It's gonna be long. Cool, guys. See you next week in any way, in any kind of shape or form. But we're gonna talk trading next week for sure. Au revoir. Have a good night and a nice weekend as well. And yeah, fingers crossed for gold and silver. Bye bye.